26, 20. Oh, sorry.
I'm sorry, I should have told you that. Sorry.
That's okay. Welcome to this May 26, 2020 meeting of the City of San Diego Funds Commission. We're going to do a quick roll call to confirm commissioner attendance. When I call your name, please unmute your line and say present. Commissioner Bruce Ives.
Present.
Commissioner John Peel.
Present.
City Attorney Mara Elliott.
Present.
City Treasurer Liz Correa.
Present.
All right, thank you. Your attendance has been noted. For the record, we have a quorum consistent of Commissioner Bruce Ives, John Peel, City Attorney Mara Elliott, City Treasurer Liz Correa, and myself, Funds Commission Chair David Tam. Also present are Brett Bartolotta, Deputy City Attorney, Patrick Everett from Northern Trust, Jeff Knipp from Miliman Advisors, Andrea Peterson, Recording Secretary, and Jeremy Shortis, Office of Boards and Commissions Liaison. Before we get into the agenda, I'd like to provide some guidelines for the logistics of this meeting. Please note the buttons on your Teams meeting bar that pops up when you move the mouse. The camera icon is to activate your video. The microphone is to mute and unmute. Please remember to stay muted when you're not talking and to unmute yourself when you speak. You will also see the chat window button. Please keep your chat window open at all times, as you will be using the chat to signal when you would like to speak. When you want to make a motion, second a motion, or participate in a discussion, please type "speak" in the chat box, and I will call on you in the order entered. Please refrain from using the meeting chat for anything other than signaling that you'd like to speak in order to comply with Brown Act. Thank you for your attention to these guidelines. So let's start with the approval of the minutes for the February 19th, 2019 Funds Commission meeting. Are there any changes to the minutes that were provided? Hearing none. Is there a motion to approve the February 19th, 2020, February 19th, 2020 meeting minutes with the changes brought forward? Liz, go ahead.
I'll make a motion to move the minutes.
Perfect. And the second? Yes, please. Thanks, John. Go ahead.
I second it.
We have a motion by Liz Correa, second by John Peel to approve. We will now take roll call to count the vote. Just say yay or nay. Commissioner Bruce Ives?
Abstain, as I was not at the meeting.
Abstain. Commissioner John Peel?
Approve.
City Attorney Mara Elliott?
Abstain. I also was not there.
City Treasurer Liz Correa?
I approve.
And myself, I vote yay. That motion passes with City Attorney Mara Elliott abstaining and Commissioner Bruce Ives abstaining, and everyone else voting yes. So we will now move on to the informational items. Item number 1 is a report from Northern Trust regarding Mount Hope Cemetery Fund investment and the performance review. I'd like to welcome Patrick Everett from Northern Trust, who is here to provide us with a report on the Mount Hope Cemetery Fund. Thank you for being here today. I will now turn it over to you.
Okay, thank you very much. I am working to get my screen desktop up.
Thank you.
There we are. You should have in front of you a page that says Account Executive Brief, which is a section of our presentation. It's page number 2. There's a page number in the bottom right-hand corner. And just is there anyone that is not able to see that document? Okay. All right. So what you will see on that page is the asset allocation as of the close of business of March 2020. and that is a column that's headed that. You'll see domestic equities were 24%, international equities 8.6%, and fixed income 63.5% to get to 100%. You will see the delta in the column to the right. That's the change from December 2019, the last set of data points that we looked at. And you will see that equities, both domestic and international, are down. That is a function of the market decline that started in mid-February and continued to close to the end of March. And fixed income is higher, and also a dynamic as a result of fixed income did better than equities during this period of time. Investment policy column to the right, you see that domestic equities are slightly under policy, which is 25%. We have 24.3. So we actually commenced the quarter at a little bit overweight U.S. equities. International equities today, the policy target is 10%. We had 8.6, and we entered the period right at 10%. You can see fixed income, the target is 65%. We are slightly overweight we're slightly underweight that at 1.5%, but you see the weight went up from the beginning of the year. And cash went up from the beginning of the year about 2%, and there was no policy weight for cash. To the far right, you see the policy range for the policy. You'll see that every asset class is inside the policy range, and there are no exceptions to policy. At the very bottom of that page, you see a lift out of detail that's in the back of the presentation for your perusal. The 3-month return of minus 12.2% gross of fees and minus 12.3% net of fees reflects the large sell-off of the equity markets and the credit fixed income markets during the first quarter. To put that in perspective, in the first quarter, global equities declined 22.4%, and your portfolio was down to 12.3%. So much influenced by the dynamic of the marketplace, and I'll get into it a little bit later, of the performance of the bond portfolio, where we own mostly corporate bonds in that portfolio, and I'll detail that as I go forward. On the following page 3, which is titled U.S. Equity Performance column, comments, I lifted out the data on the global equities and U.S. equities in a period of time like this, where we've had a significant move in the market as a result of responding to the economic disruptions caused by the COVID-19 economic shutdowns. I think it's important to look at the portfolio, and this portfolio has 28% of the holdings are in global equities at the close of the period. And you see to the right of that, both the 3-month return for the global equities and the 1-year return, to just a perspective. So as we walk down the lines, global equities were down 24% for the 3 months ending March 30. When we look at that compared to the MSCI All Country World Index, it was down 22.4%. If we then separate just out the U.S. equity common stock portfolio that we own, which is about 21.8% of the total portfolio, so a subset of all the equities, it was down 24.8% for the 3-month period of time. If you would take a simple S&P 500 equity index benchmark, you would see that that was down 19.6%. And you would ask yourself the question, is our portfolio different from the S&P 500? And the answer is, it is different for a number of reasons. One is we can't own stocks that do not pay dividends. And so when you look at our equity portfolio and characterize the portfolio, about 75% of the names in it would fall into the value US category, and they all pay dividends. So if you look at an index that was more similar to the portfolio, that might be the Russell 1000 Value Index, and it was down 26.7% for the 3-month period of time. And so you can see that compared to the equity common stocks, the common stocks actually outperform that. To provide a little bit more contrast, I provided down below in the second block the factor returns on the Russell 3000. So what this does is it looks at the Russell 3000 index, which is an index that represents the majority of the US equity market, and that index return did 20.9% minus for the 3 months, so very similar to the S&P 500. But if you then look at what we call factors, or those stocks that have dividends versus those stocks that don't have dividends, and so these measures take the top quintile of dividend paying stocks and compare that to the bottom quintile so that you can see, did dividend stocks do better than the index? And the answer is the dividend yield stocks did minus 38%, so materially underperforming the index during this period of time, just a characteristic of the last 3 months. If you then also take and look at quality, companies that have very solid balance sheet, good debt to capital ratios, good profitability, that subset of the top versus the bottom did a minus 37% for the 3 months. So the conclusion there is high quality companies did not do as well as lower quality companies in this market downturn. And finally, when you look at the value characteristics, stocks that are inexpensive, they were an underperformer, minus 43% during this period of time versus the index of minus 20%. So your portfolio is a very high quality portfolio, has a value tilt because it has to pay dividends, has a dividend yield to it because all the stocks are in that category. And as you can see, that's a little bit of color. We would expect a portfolio like this to be less than the S&P 500 during a period of time like this, just because those group of equities underperform. The other component that I'll bring to light as you look at the bottom of the page, impact of selected, and I'll call them FANG stocks, and Facebook, Amazon, Netflix, Google, which is Alphabet, in the S&P 500. These are all stocks, part of the technology component. They don't pay dividends, so they're not in our capable universe to buy. You can see they make up totally about 10% of the index of the S&P 500. When you look at the performance of those stocks for the 3 months, you'll see Amazon made money, Netflix made money, Facebook was down, but not as much as the market. Google was down, but not as much as the market. So that portfolio of stocks was only down 4%, where the index was down 19%. So characteristic of the last 3 months, and even over the last year, you'll see those numbers. You'll see these technology names that do not pay a dividend are doing far better than the market as a whole. So I wanted to provide you that color of the dynamic of what has happened for the 3 months. We see these factors cycle in favor, out of favor for the last quarter and the last year. They have not been keeping up with the general index.
Okay.
If you look at the following page, which is page 4, what you'll see is I've done a similar drill down on fixed income to provide you those characteristics. The portfolio we had was down 4.9% during the period of time. The Barclays Aggregate Index was the benchmark that we use. It was down 3.1%. So one would ask, why are you down materially more? One, we own U.S. high yield in the portfolio intentionally, so we treat it more like an equity type asset, although it does fall into the fixed income category. It was down about 11% versus equities were down 22%. When we look at the components of our portfolio, intentionally, we have been running a portfolio that has more corporate bonds in it than the index, the Barclays Ag Index. And that has been intentional because we're getting paid 150 basis points more of yield by investing in the corporate area than the government area. And that has been important to the yield that the cemetery fund requires. And you see the returns for the last 3 months. Anything that had a corporate bond category to it was a negative number. Our government bonds were positive. And down below, you see why that's the case. The Barclays aggregate is about 73% AAA rated bonds. Those are government and government agencies. And those bonds did extremely well during this last quarter when we had a flight to quality. People were selling anything that they could. There was limited liquidity in both equities and corporate fixed income because people wanted to own government money market funds. And the Federal Reserve lowered government rates while in the marketplace we saw corporate bond rates actually go up as spreads increase. So corporate bonds did poorly versus the index. Government bonds did extremely well because of that flight to quality phenomena. That has since reversed in April, and corporate bonds have done extremely well after the month closed because the bottom of the market was March 23rd. So with that, I will open it up to any questions there might be.
I have a question. This is David. With what's going on with the strain on local government budgets, how do we see that impacting the bond portfolio if the federal government doesn't step in?
And that's an excellent question. And this portfolio does not own municipal bonds. So the predominant issuers in the municipal bond markets are municipalities and state governments. And so we don't own that debt. So we'd only be influenced if there are insolvencies or organizations which have trouble paying their bills. And so when we look at that component, we have already seen municipal debt, the spreads on municipal debt grow at least as large as the spreads of corporate debt. And in fact, in many cases, municipal debt is actually yielding more than comparable dated treasuries or even some corporates. So we're already seeing that in the marketplace. Our view generally is bonds that are secured by dedicated revenue stream, water, power, those sorts of things are generally secure. State of California GOs are generally secure. There will be, however, some bonds in some states where the liquidity ratios are not as high as they should be. We'll see those under pressure, and they've already been repriced in the marketplace. And there's always, of course, discussion of what the federal government is going to do to be able to help the liquidity of some of these municipalities. And there's great discussion about those who are in the circumstance they are because of the current crisis, as opposed to fiscal irresponsibility, visa pension plans and things like that. So that's kind of the long answer to your question.
So Double Line doesn't have any exposure to taxable municipals, or any of
has,
those funds?
Yeah, the LQD would not, and the Double Line, when I looked at their last portfolio, did not have taxable municipal exposure.
Okay. Follow-up question. Are you still, as a firm, comfortable with having 9.4% in high yields, just based on the amount of volatility and the uncertainty of revenues going forward for a lot of companies with lower credit quality? over the next 12 months. What's your firm's take on the high yield sector?
Yeah, and that's an excellent question. And in our view, we still like the asset class. We have moved the weight down today to about 8%. So we've taken some money off the table there because we've seen appreciation of the asset. Our view is that because of the COVID crisis that went on, the spreads for high yield became substantially large. They went up to about 11% from about 3.5%. History will tell us that as things settle down, those spreads come down, and we've already seen that to be the case. Today's spreads in the high yield area are about 770 basis points from what was 1,100 basis points on March 23rd. And so our view is spreads will continue to go down. So we will expect to be able to collect the coupon that's a little bit under 8% now, plus see some appreciation in the asset class. We already believe that the potential bankruptcies that you see are priced into the price of the bond portfolio, the high yield portfolio that we see, because it is selling at a discount already to par. Which is not abnormal in high yield as it fluctuates. But we see an 8% cash flow yield, but a 6% coupon. So potential defaults are somewhat already priced into the price of bonds. So when we think about taking risk in the overall portfolio, if you took a snapshot of where we are today, we'd have a little bit of high yield in the portfolio because we like that as a U.S. asset. And we are overweight U.S. equities because we like U.S. equities as a U.S. asset. We are underweight overseas equities because we think they will come out of the downturn more slowly than the U.S. assets will.
Okay, and it looks like we have a question from Commissioner Bruce Ives. Bruce, go ahead.
Thank you. I'm just curious, what type of impact, if any, will there be on the fund's ability to generate the type of cash necessary to support its charter based on the type of reduced dividends that could potentially occur, as well as obviously the negative returns?
Yeah, and that's a great question. We certainly have experienced the first quarter negative return, although April, we've made back a good deal of the decline during the first period of time. The S&P as of today is only down about 7% year to date. So there is an impact on the market value of the overall portfolio as a result of any decline in the risk asset. Today, we see a yield on the portfolio of about 3.6%. Looking at all the current dividend payers and the current yield, that's up a little bit from the 3.5% yield and coupon yield that we saw at the end of the year. And so we are keeping a good eye on our dividend paying stocks because we do expect, and it's not going to be a surprise to us, that some of the companies may cut their dividends. So we're looking carefully through the portfolio holdings that we have that are all dividend paying at the current time. And to the extent that we think that a reduction in the dividend is on the table, and that reduction of the dividend will impair the expected long-term return of that equity. And we're looking critically at should we make any swaps there. And so we haven't done that. We last rebalanced the portfolio in April and rebalanced our sectors, et cetera, making sure that we had current dividend yields from all the stocks, and we're minimizing the ones that we thought might be more impaired than others.
Thank you.
Okay. Are there any other questions? Okay, Mr. Everett, thank you for providing the Funds Commission with this report.
Thank you very much. It's a pleasure to join you today.
Note for the record that this is an informational item. There will be no commission action. Let's move on to item number 2, introduction of new investment advisor, Miliman Advisors, LLC. I'm going to turn it over to Jeremy to provide an introduction.
All right, thank you, David, and good afternoon, commissioners. I want to provide everyone with an introduction to our new investment advisor for the funds overseen by the commission, excluding the cemetery fund, as well as provide a little background on the selection process. Just as an FYI, I did provide the commissioners with Miliman's response to the RFP scope of work prior to this meeting, and a copy can be requested by the public by sending an email to Andrea Peterson at the email address indicated on the agenda. As many of you know, the city's contract with Canterbury Consulting ended on March 24th, 2020. In preparation for the end of that contract, the city issued a competitive RFP on December 31st, 2019 to prospective proposers for investment advisory services to be provided to the city's funds commission on all funds except for the Cemetery Perpetuity Fund. The RFP process involved the city compiling requirements for the services sought, which we call a scope of work. And the scope of work requirements were mirrored after the previous scope of work put together back in 2015, and it included the input and review of Liz, our city treasurer, Brett, our advising attorney, and our purchasing contracting liaison, and myself. Once the requirements were finalized, the RFP was published on December 31st, 2019 on the city's purchasing and contracting Planet Bid site. Proposers had 4 weeks to submit their proposals. The city received 3 complete responses to that RFP, and the responses were evaluated by the evaluation committee, which was selected by city treasurer Liz Correa. The evaluation committee consisted of Tricia Mendenhall, who's one of our minimum wage program managers, Manny Labrinos, who's an assistant investment officer, and myself. Proposers' responses were evaluated based on the following criteria: responsiveness to the RFP, staffing plan, firm's capability to provide services, expertise, past performance, price, and presentation. After careful consideration and scoring the proposals, the evaluation committee unanimously made a recommendation to award the contract to Miliman Advisors, LLC. The contract was signed and executed on March 25th, 2020. I received a few questions regarding the whole RFP process and what role the commissioners could play in any future process, and I followed up with our purchasing contracting department to ask about this. For this particular RFP, there was a time sensitivity involved since the new contract needed to be in place by March 25th, since the former contract terminated on March 24th. For future RFPs, though, a limited number of commissioners could be invited to serve as advisors to the evaluation committee, which means you would be reviewing the bid proposals but not be part of the voting or scoring process. Please keep in mind that this would involve needing to be available during the evaluation process. Just to get a gauge of interest for something like this, are there any commissioners who would like to be considered for the role of an advisor to the evaluation committee for any future RFPs?
Looks like no one is on chat, but I would like to indicate my interest.
Okay,
This is David.
I'll mark that down. Okay, David, I've got you noted. Okay. And if any other commissioners decide that they would like to be considered for that, please, you can reach out directly to me, and we'll make sure that you're considered in that, and then another process. And then just a little bit of background on Miliman, which I'm sure you all saw in their response to RFP, is that their practice includes more than 150 institutional investment clients with assets of approximately $40 billion. Additionally, they have been retained by the city's risk management department for more than 22 years as an investment advisor to the city of San Diego's defined contribution and savings plan. There is a wealth of additional information in their response. And with that, I'd like to extend a warm welcome to Jeff Knipp, who will be our primary account representative and is a principal and senior investment consultant for Miliman. Are there any questions on the RFP process or for Miliman?
Doesn't look like it.
Okay, I see none. All right, and I'll turn it back over to you, David.
Okay. Thank you, Jeremy, for the intro. Note for the record that this is an informational item. There will be no commission action. Let's move forward to items number 3 and 4 together. Item 3 is a report from Miliman regarding business and economic outlook. Item number 4 is a report from Miliman regarding the performance of the funds. I would like to welcome Jeff Knipp from Miliman Advisors, LLC, who is here to present these 2 items. Thank you for being here with us today. I will now turn it over to you, Jeff, for the update.
Great, thank you very much, and thanks to all of you for this opportunity. I have to say the low point of the market was March 23rd, and we started here on March 25th. So I'm sure there's a correlation between what's happened since then and us being hired. I'd like to think that anyway. I'm going to try to share my screen for our report. And just a reminder, Jeremy sent this out this morning. This was a revised version of the original one that we had done. There were some issues with the calculation of the total fund benchmark and the policy weightings that hadn't gotten updated in the spreadsheet we got from when the policy was updated in 2019. So didn't have much effect on performance, but it did affect the allocations. So we wanted to make sure we had that accurate. So this report here is the corrected version. You've already heard a good bit about what happened in the quarter, so I'm not going to repeat all that. But going to this page of our report, it's page 1 in our report. You just see a list of returns for various market indices. Obviously, equities across the board, really ugly. Really, the only thing you wanted to own in the first quarter was Treasury bonds, especially long Treasury bonds. Anything else probably had a negative return. And Patrick alluded to this a little bit too. Huge difference between growth and value style returns, and that has continued even so far this quarter. I think the difference is over 20% now between growth and value returns. Growth benchmarks are now generally positive year to date, whereas the value benchmarks are still substantially negative. You've also seen huge divergence between large cap and small cap equity returns. Again, the first quarter S&P 500 was down about 20%. Russell 2000 was down over 30%. That started to turn around a little bit with small caps having performed better so far this quarter, but it's still a pretty big divergence for the year-to-date period. So with that as background, wanted to move ahead. There's a lot of commentary and data here, which I'm happy to get into if somebody wants to, but I thought I'd go just to a couple pages. We are not short-term market forecasters. I don't think anybody's really good at that. But I found a couple of interesting slides that I wanted to share. This one is a survey of economists. And you can see that this group of economists expects the V-shaped recovery. And you hear a lot about these letters, V-shaped, U-shaped, L-shaped, even W-shaped, which is down, up, back down, and then back up again. So you can kind of pick your letter, as this slide says. This group of economists, I think it was like 75 economists, were pretty positive that things were going to turn around quickly. In the stock market, at least, that has happened. I think economically, it's a little bit different story. And I think what you're probably going to see really is all of these letters will come into play. Certain sectors probably come back quickly. Others may take a long time. Others may never come back. I mean, you've already seen some companies go bankrupt and just go away. I think the one thing we can count on is volatility in the short term. I thought it was also interesting on this next page. So that was economists. This was a poll of CEOs. And whereas the economists were pretty favorable and they were expecting the V-shaped recovery, the CEOs, not so much. Majority of them look for the U-shaped recovery. And there's a lot of sort of pessimism here from this survey. And these are the people actually running the businesses, and they're seeing what's happening to them. So again, a lot of unknown. Really, nobody's ever dealt with anything like this before. So we'll see what happens. Like I said, I think volatility is the one thing we can pretty assuredly count on going forward. This being my first meeting, I'm not sure how you typically do these, but what I thought I would do is use this particular fund as an example. They all obviously have the same policy benchmarks. The allocations are all within 1 or 2% of each other in terms of where the actual allocations are. So I'll use this one as an example, but if we want to look at any of the other funds specifically, we can. So this page is just the quarter end current allocations on the left versus the targets. Not surprisingly, underweight equities, both domestic and international, by 2 or 3% each, and overweight fixed income. And that's purely coming from that huge divergence in equity and fixed income performance in the first quarter. Again, this has already started to turn around. And with the really strong returns we've seen, I think small cap stocks are up close to 20% now this quarter. Large caps up more than 15. International's up a lot. So these gaps between your actual allocations and your targets are closing. They're probably about half of what they were as a quarter end, as a rough estimate. Skipping ahead. This page just shows where you started in this particular fund, 3.3 million, a little bit of cash flow coming out, and 500,000 plus in investment losses, so down to 2.7 million at the end of the quarter. And again, the numbers will be different for the other funds, but the picture is directionally the same. From a performance standpoint, it was pretty ugly. So you can see top line, this total fund portfolio was down 17.1% for the quarter versus 13.5% for the policy benchmark. A couple things going on here. One is you have more exposure to small cap stocks than the US benchmark, equity benchmark, which is the Russell 3000 does. That has less than 10% exposure to small cap. If you think of the Russell 2000 is less than 10% of the Russell 3000. Whereas you've got about 30% in your small and small mid cap portfolios. So a pretty good bias in your portfolio towards small cap. And clearly that did not help you in the first quarter because, as I said, small caps were down, roughly 10% more than large caps were down. So just that allocation alone was one of the drivers of your total plan underperformance. Also, there's the impact of the returns by the active managers. Most of them trailed their benchmarks, as you can see from the red. And in the fixed income area, every single manager underperformed. But that is not at all surprising, given, and Patrick was talking about this too, that most bond managers are going to own corporates and mortgages and things that are yielding more than treasuries. And so they almost always underweight treasuries relative to the benchmark weight. And that didn't help in the first quarter. Again, this quarter so far, that's turning around. And one of the important things that has happened was the Fed stepping in late March to not only slash interest rates a couple times down to virtually zero, but to also step in and start buying bonds, not just treasuries, not just mortgages, which they did back in the financial crisis, but they're also buying corporate bonds, even some high yield bonds, which they've never done before. And that's done a couple things. One is it greatly improved liquidity in the bond market. I've had some bond managers tell me that there were a couple days in March where you really couldn't trade anything, even treasuries. And then the other thing is kind of given a floor to those other sectors besides treasuries in the bond market. And again, you're starting to see improvement so far this quarter in the returns of those non-treasury sectors. So just kind of quickly going down the list, DSM, kind of the star U.S. equity performer, They have a very concentrated portfolio with a lot of the big tech stocks. Patrick was talking about how relatively well those did. So they came out ahead of their benchmark, still down 13%. Vulcan, small cap value, which is small cap value was the worst place to be, and they took it on the chin. They had some hotel holdings and some other things that the sectors that really suffered. Fiera pretty close to the benchmark return, and Boston Partners again as a value manager. Sort of all bets were off, and Patrick mentioned quality. Well, quality is important to these guys, and that underperformed in the quarter. On the international equity managers, the Euro-Pacific Growth Fund did very well, again, relatively speaking, ahead of its benchmark and has consistently done so. We actually have a lot of clients who use this fund, and it's done well for a long time. Dodge & Cox, on the other hand, underperformed. They had a lot of financial exposure, especially in Europe, and with Italy and Spain shutting down and all the problems that were going on there, that really impacted those holdings. They also had some energy holdings, and you'll remember that one of the other problems especially in March, was this oil price war between Russia and Saudi Arabia, and a lot of the energy stocks were down more than 50% in the quarter. So the fact that Dodge & Cox had not a lot, but some of those weighed on their performance. On the bond side, here on the next page, as I mentioned, the total bond portfolio down about 2%, whereas the U.S. aggregate benchmark was up 3%. And both PIMCO and MetWest actually did pretty well. They underperformed by less than 1%, but that was pretty good. I've seen some that were a lot worse. Western, the WAMCO Core Plus, that was down 2.2%. They had a good bit of exposure to emerging markets bonds in their portfolio, which really didn't help them. And that emerging markets theme continues into the two global portfolios down there at the bottom, especially for Brandywine. They had a lot of exposure to emerging markets, and that really hurt them. And again, they're being measured against a world government bond index, so purely government holdings, which was up 2%. Templeton also was down, also had some emerging markets exposure, not as much as Brandywine. But you can see if you just compare the benchmark returns, the world government bond index was up 2, the U.S. aggregate was up 3. So having those global portfolios, which clearly I wasn't here, but they were only added a year or two ago, that detracted from returns because you're measuring this against the U.S. aggregate benchmark as the policy benchmark. So that's kind of the performance picture. Again, if anybody wants to look at any of the specific either funds or managers, mutual funds, in more detail, we can do that. Or if there's any questions, I'm happy to take this.
Okay. Like we have a question from Commissioner Bruce Ives. Go ahead, Bruce.
Hi. First of all, welcome. Thank you for being here. I'm just kind of curious from a lessons learned perspective, looking back on what we know now. What is the most significant aspect of the underperformance? Just looking at the current portfolio, what would you say, if anything, we need to look at changing, or is it one of those situations where we just experienced a very rough patch and things are coming back and we should probably hold as is and just rely on our overall portfolio structure the way it is currently?
Yeah, it was a very difficult quarter for active managers in general. I talked about the bond side. In any bond manager that outperformed is surprising, and so that I'm not really worried about. I think active management and fixed income makes sense most of the time. It's going to work. Getting that yield advantage that Patrick was talking about pays off over time. So you get these occasional flight to quality periods. the bond managers are going to lag, but I don't worry too much about that. I think on the equity side, clearly most of your managers underperformed for a variety of reasons. This was one of those quarters where fundamentals didn't really matter very much. It was just everything was down. It was just a question of how much, except for a few pockets, especially like healthcare and some of the technology companies. There were a few stocks that did well, but almost everything else was bad. And again, the fundamentals, which is what a lot of these active managers look at, that just didn't matter. So there was a headwind. I do think, as I mentioned, the fact that you've got this small cap bias, which again, over time, you would expect to help you. Small caps generally are considered to have higher returns over the long term. But that was a big drag in the first quarter. So what you want to make sure of is that's intentional, that you're happy to have that kind of bias in your portfolio. The other thing I would mention just at a high level is you've obviously got, other than the one S&P 500 index fund, you've got active managers. And because these are mutual funds, you often have to sort of pay up in fees to get these. And like the small cap portfolios have fees of over 1%. That gets to be a big hurdle to overcome, especially in difficult markets. So, I think it's just worth keeping in mind that at the size that these portfolios are, you have to use these mutual fund vehicles, and you need to be careful about how much you're paying for some of these things. You don't want to put the managers so far behind before they even get started that they've got to be like the world's greatest manager just to break even.
Thank you.
All right, I have a question. This is David, and wanted to get your take on our international target and also kind of our small cap target. What do you think going forward? What's your firm's opinion as far as overweight or underweight on international and also small cap, mid cap?
Yeah, so I'll put this in the context of the work we do. We don't make short-term or even medium-term forecasts. What we do are 10-year capital market projections. And it's based on a combination of long-term historical returns and current valuations. So I can tell you that given what's happened with basically large cap US outperforming everything else, going forward from here, and we're going to update our projections at the end of June, we will see higher projected future returns, 10-year returns, for small cap and for international than for large cap US. So just from a going forward standpoint, I think having a bias towards those two areas, if that's all you knew was our projections for the next decade, say that's probably a good bias to have. Now, what that creates in the short term is the possibility, because these tend to be more volatile sectors of the overall equity market, it's a bouncier, rougher ride than if you just sail along in these big, stable, large cap U.S. companies. So I think as a committee, you just have to make sure you've got the stomach for it. But if I was starting fresh today, I think, yeah, I'd be happy with a small cap and international bias to my portfolio.
Okay, thank you. Are there any other questions? Hearing none. All right, Mr. Knipp, thank you for providing the Funds Commission with this report. Note for the record that this is an informational item. There will be no commission action. That concludes the informational items on our agenda today. We do have 2 action items before the commission today. Item 1, recommendation from Miliman regarding Canterbury Consulting non-U.S. equity segment of the fund portfolio proposal. So again, I'll pass it over to Jeff to present this item to the commission.
Okay, thank you. So I asked Jeremy to re-provide you with what Canterbury had presented at the last meeting, and I would say I don't disagree with any of the information they've got here. A lot of it is factual, and I get the point about what they were recommending in terms of adding this international small cap exposure. However, there's a couple things that are going to lead me to recommend that you not do this at this time. One is in talking with some managers about this opportunity in general. They're clearly, and Patrick alluded to this too, a lot of the economic conditions that countries around the world are facing right now are very uncertain. And small cap stocks are more exposed to economic growth or lack thereof, much more cyclical. So that's part of what leads to the volatility, and we saw that volatility in the first quarter. But the general consensus from the people I've talked to is that, yeah, this probably makes sense theoretically, but I don't think you have to rush into it. This opportunity is probably in international small cap is probably still going to be there for a while because, and this is exactly what Patrick said, a lot of these foreign economies are probably looking at a much longer road to get things turned around than the U.S. is. So I don't want to be overly tactical, but I think that a consideration is that it's not like you have to jump on this today or you're going to miss it. The economic conditions in these countries probably mean you can take your time with this. From a more practical standpoint, one of the issues I've got with what Canterbury was proposing, I'll get back here to this page, is this, you can see in the green highlight, it's only a 3.7% position in the total portfolio. Really, anything under 5%, I find myself saying, why bother? And again, I'm not sure I'd put 5% in international small cap right now. But a smaller amount than that, it really is not worth doing because it's not really going to have any impact, no matter how good it is, on your overall portfolio. I'll also point out that this particular fund that they're recommending, I think is a very good fund. It's performed very well, and it performed very well in the first quarter too. But I'm sure if the data's in here or not, they're talking about the institutional share class of this fund, which has $1 million minimum, and you don't have that much money. And even if you put 5% of your total portfolio and added up all the funds together, you're only about halfway there. So what that means is you'd have to use a more expensive share class, which is something close to 120 basis points. I wrote it down. Yeah, 119 basis points. So again, that's one of those big hurdles for active managers to overcome. Other thing I would say, and this is not at all a criticism of Canterbury, but this particular fund is a concentrated portfolio, and so after they've made the case for exposure to international small cap as an asset class, this particular fund, and we saw it in the first quarter, may act nothing like that asset class in terms of performance. Now, you hope that means that they outperform, but it goes a little bit counter to their whole argument about why you should have exposure. The implementation that they're suggesting isn't really consistent with the argument they're making for the asset class. Again, I think it's a good fund. We know some other good funds that are available, I don't like having to pay 1.2% for it, but I don't have any problem with the way they manage the portfolio. So overall, you asked me for a recommendation. My recommendation is to not allocate to international small cap right now. We can always revisit that at some point. Maybe as assets grow, we've got more money to work with, we can look at that. The other point I would make is, as I was just saying, you are overexposed to small cap in the US. So I'm not sure I'd add more small cap exposure right now. You've got enough in the US. And given all that, my recommendation would just be hold off. We'll keep an eye on it. We'll revisit at some point, but don't do it right now.
Okay. Jeff, thanks for bringing this item to the commission. Are there any questions or comments? Hearing none. This item does require a vote of the commission to decide on whether to accept the recommendation from Miliman regarding the Canterbury Consulting non-U.S. equity segment of the fund portfolio proposal. Is there a motion to accept the recommendation from Miliman regarding the Canterbury Consulting non-U.S. equity segment of the fund portfolio proposal? I'll go ahead and move to accept the recommendation from Miliman, which is to not go with the Canterbury Fund. So I will move to accept the recommendation.
And this is Bruce Ives. I will second.
Okay, perfect. Is there further discussion on the motion? Hearing none, we have a motion by myself, David Tam, and a second by Commissioner Bruce Ives. We will now take roll call to count the vote. I'll start with Bruce.
Aye.
Commissioner John Peel.
Aye.
City Attorney Mara Elliott.
Aye.
City Treasurer Liz Correa.
Aye.
And myself, David Tam, I vote aye. That motion passes unanimously. Now we move on to the last action item on the agenda. Proposed item number 2, proposed investment policy changes from Miliman. Again, I'll pass it over to Jeff to present this item to the commission. Go ahead,
Thank
Jeff.
you. Okay, so I am now sharing. I hope everybody can see this. This was the draft that I sent out of your investment policy statement. Not a lot of changes that I'm suggesting here. Some of them are just wording changes, especially here on the first page. There were a couple of areas. So here at the bottom of the second page, it's up a little bit. So as I mentioned when I was going through the performance report, the policy benchmark for fixed income is the U.S. aggregate index. But you added these two global portfolios a year or two ago, which is creating a little bit of divergence from that policy benchmark. I asked the question, or I said perhaps the global aggregate should be the policy benchmark, but I'm not sure that's perfect either, because you don't have 5 global portfolios. You have 3 U.S. portfolios and 2 global portfolios. So this was really just, I think, a point of discussion of whether we're happy to just leave it with the U.S. aggregate and recognize that we've got this essentially non-benchmark allocation in our fixed income portfolio, or I think the other realistic alternative would be to do a weighted average combination of the U.S. ag and the global ag to create an overall fixed income benchmark for the portfolio. So I mentioned that a couple times in here. And this is where I could actually use a little history on the rationale for introducing the global bond portfolios in into the overall, or into the fixed income portfolio. And what was talked about then, if anything, in terms of benchmarking.
Let's take a look here. Well, I'll put in my 2 cents. Originally, this was purely a U.S. fixed income portfolio, and the international was recommended to be added by Canterbury, I believe, over a year ago. But I think we have the history on the statements that you have. But essentially, it was to take advantage of the valuation opportunity that we saw in international at the time. I mean, moving forward, we're open to reducing international if we feel we want to reduce the potential currency volatility and also get us back toward that Barclay Ag allocation by reducing international.
Okay, thank you. That's helpful. Yeah, I think this is something we can work on going forward. One of the interesting issues is that your two global bond managers, Brandywine, which is owned by Legg Mason, and Franklin Templeton, are about to all be part of the same firm, because Franklin Templeton is acquiring Legg Mason. So while these are two separate teams on different sides of the country, they are going to be under the same roof organizationally, essentially. And we'll have to see what happens. They probably will keep both teams, and because they do things differently. But it does raise the issue of do you really need or want both of them? Maybe having one might make sense. But that's something we can think about going forward. So I think, given that, maybe it makes sense, if everybody's comfortable with that, to just leave the benchmark as it is, the U.S. aggregate, and just be aware that we've got these global portfolios. So we're getting some non-U.S. exposure that's not in our policy benchmark. But that's perfectly fine. It's just something that everybody needs to be aware of and comfortable with.
Got it. And then a good thing maybe for the next meeting is just a review of the current funds, especially the small caps and the international, just to see if there's maybe a better alternative with lower fees and a better track record, since we have a new manager on board.
Yeah.
I would agree with that.
Okay. I will make a note.
So the action item is to accept the Barclay Ag. Is that right?
Well, I think, and a lawyer can correct me if I'm wrong. I think what you're going to do is accept the whole policy,
Okay.
or we may have to make some more edits to it. So we may not even get there today. But rather than every little point I'm going to hit, I think it's the overall policy that you're going to accept.
Okay. So we're going to accept the current investment policy as is, which is to maintain the Barclay Ag as the index to the fixed income portion of the portfolio.
Right, but that's
Does that sound right, Jeff?
Well, that's just one component of this overall investment policy. So, and
Understood.
Yeah, again, a lawyer can correct me, but given that you're keeping what you've got, I don't think you actually have to do anything.
Do we need to accept this as modified as you're presenting it now?
Well,
No,
I think
we're not modifying it, I think, is what Jeff is saying.
yeah, the overall policy, I'm suggesting some modifications. So I think let's walk through all of these, and then either we're happy with all of those, or I need to go back and do some other things, and we'll see where we come out.
Right.
Okay, so the next item was on the next page, and this is just the ranges for the various asset classes. And I put the comment here that almost always we see symmetrical ranges. So for example, U.S. equity, if the target's 40%, it's plus or minus 10% either side of that. 30 to 50 is the range. That's not what you've had, not what you have right now. Your current range is a minimum of 30, a maximum of 60. Again, I don't have history. I don't know if that was done for a particular reason. But if there's not, then I think they should be symmetrical. There may be a good reason to do it that way, and that's fine. But in the absence of that knowledge, I'm suggesting that we just make these symmetrical on either side of the target.
Okay.
And then, let's see, okay, on the next page, again, we've got the issue of the fixed income benchmark. So we've talked about that. I rewrote the language about the duration of the portfolio and took out this talk about cash using alternative to other investments. That's what each manager is going to do, but that's implementation, not policy.
Mm-hmm.
And then down here at the bottom, and I had raised this with Liz and Jeremy when back in April when we were looking at these quarterly distributions. So the policy calls for the amount to be calculated based on 1.25% of the total fund market value as of the prior year end. And given that this calculation, as I understand it, and it even says here, will be recalculated in July, I was wondering, why are you using 6-month-old amounts? Why not just use what it was at the end of June? Or take an average of the prior 3 year ends, or you could do end of March, something. It just seemed odd to be going that far back to be calculating these distributions. And again, I don't know if there's a particular reason for that, but it seems to me that we could be a little more up to date with knowing what the fund market values are as we're then calculating those distributions.
That might be a good question for Liz. Do we know why the date is so far from the original calculation?
So this is Liz. I don't know exactly why that date was selected for the calculation, but I do know that it's been in place for quite a long time, and we found something, I think, going back probably, Jeremy, about 20 years or so in the file. I do like the idea because, as we know, if we take a one point in time, as of right now, I think December would be a high point of the market, and we know that there's been a significant impact on our funds since then. So it seems to me that it would be more prudent and responsible to take an average, as Jeff is suggesting. And so that's my 2 cents on that. I don't know if any other commissioner has. Jeremy, it looks like Jeremy has some thoughts.
Yeah, so as far as like the history, I believe the reason why we picked December 31st has historically been used is because the departments who use these distributions have to have that, they need to know what the distribution amount's going to be for budgeting purposes for the next fiscal year. But I think maybe picking a March 31st ending value and doing the average over 3 years, I think that's something that seems absolutely reasonable.
Yeah, that'll smooth out the volatility.
Yeah, and this is Jeff. I can tell you that some other clients that we have, primarily endowments and foundations, they typically use an average. And I think a 3 year average is pretty standard for how they calculate that.
Yeah. Okay.
So if you want to use a 3 year average as of March 31st of each year, I can rewrite this to reflect that.
Yeah, let's do that, and then we'll stick with the Barclay Ag as the policy benchmark, and then maybe next meeting we can take a look at reducing some of the global fixed income based on what your recommendations are.
Sure. I think just a couple of other things. This was just said something was going to be reported that's not actually reported, so I took that out from mutual funds. And then on these funds with quarterly distribution, the Peters fund just is missing the information that's shown for the other ones, and I wasn't sure why that was the case. And then the green fund there, the one on the bottom, my understanding is that this is distributions are upon request, not every quarter. So since this is supposed to be a list of funds with quarterly distributions, it seems like it shouldn't be on the list, or it should be on a separate list or something.
I'm going to defer to Liz on this one.
So this one, since it's a new fund, I think the intent was to have regular quarterly distributions, but seeing as though it's a new fund, I don't believe we've made a determination on when that should occur, given that the corpus, has to remain intact. Of course, I don't know where the fund stands today compared to where we started. But I do believe that's why we haven't made any distributions.
Do you know?
And this is Jeremy. Sorry, this is Jeremy. I can just speak to the Peters. I believe the reason that doesn't have the other information is because it's not a permanent fund. It's a special fund where the corpus and the income can be used.
Okay, thank you.
Yeah.
Liz, do you know, so for the green fund, it said, and this was when the policy was written before, it said additional donations basically coming in 2019. Do you know if there were additional donations in that fund?
I don't believe there were. Jeremy, could you speak to that?
There is one additional donation that is anticipated to come in this year. But I believe it is only going to, it's going to be a minimal amount though.
Right. And we didn't receive anything additional in 2019, correct?
Correct.
Sounds like there was a delay.
Yeah.
But your understanding as far as the green fund is that we were going to have normal distributions, correct? That was the intent of the fund.
Yeah, I think that was the intent, but I feel like we talked with Andy, the director of Parks and Recreation, or assistant director, and we had indicated to him that the normal distributions probably would not occur, probably
immediately.
For a couple of years.
Correct.
Exactly. Yeah. Yeah.
So given that, Jeff, I don't know how you feel it should be noted, but at some point they would like to receive quarterly distributions, but I think it depends on the value of the fund and to ensure that essentially the corpus is not expended.
Right. Yeah, so I would say given that we just take it off the list right now. And then when the time comes that you can start making quarterly distributions, then we'll just have to be sure to put it back on the list.
Correct. That makes sense.
Yeah. Okay. So yeah, I'll just delete it from there.
Okay.
And that was it for. So again, most of these are minor, just a couple of kind of philosophical things there. But overall, I've seen a lot of these policy statements, and this one is a lot better than most. So thank you.
All right. So it sounds like we might need to table this action item for the next meeting after your rewrite. Is that correct?
I think that sounds right. Yes.
Okay. Perfect. So Liz and Jeremy, I'm just going to table action item number 2. Do I need to create a motion for that?
Commission Chair, if I could just intervene really quickly before we move forward. The only thing that I'm concerned about is if we move forward with the distributions for the 3 funds that are going to require the normal distribution. I don't know if we want to consider at least updating the portion to do an average instead of taking December 31st. I'm not sure what the outcome would be long term of making that distribution based on December 31st as opposed to a 3-year average, but just one consideration.
Jeff, what are your thoughts on that?
Again, some legal advice might be helpful, but I think you can, well, I don't know, but if you could just make a motion to base the distribution calculations on the average balances as of March 31st of each of the last 3 years, then when it comes time in July to calculate these, then that's what we can do, and we'll then reflect that in the revised policy.
So you could simply, this is Brett Bartolotta, Deputy City Attorney. You can make a motion to accept that one proposed change immediately with further changes to be brought back.
Okay. Perfect. Anything else, Jeff?
One other thing, which is sort of policy related, but it's not in the policy statement. Just back in the performance report, I noticed that all the U.S. bond managers are compared to a core bond universe, but these are all core plus bond funds, meaning they can hold high yield and non-dollar and things that are not in the U.S. aggregate index. And I'm not sure why, that's probably just a legacy thing. We left it that way in this quarter's report, but going forward, unless somebody's got a problem, I'm going to use a different universe. I'm going to use the core plus universe in the performance report. And I just, that doesn't require a vote or anything. I just wanted to make people aware of that. Because I think that'll be a more accurate reflection of what these funds are doing.
Got it. All right, so I am going to go ahead and make a motion to accept the change to the distribution calculation for a 3-year average dated end of March. Is that correct?
Yes.
Okay, perfect. So I'm going to go ahead and move to accept the calculation for the quarterly distribution to make it a 3-year average dated end of March for the funds that are going to require distributions in July. So let's go ahead and vote on that. Well, actually, no, I'm going to need a second on that one.
I'll second that.
Okay, we have a second by Liz Bria. We will now take roll call to count the vote, and I'll start with Commissioner Bruce Ives.
I just do have one question. Because this is a pretty substantial change going from year end, a one point in time year end, to a 3-year average, is there anybody else that we need to run this by before we authorize this? It just seems like a significant change to the policy. I'm not sure who is or isn't going to be impacted by this, but I don't know if we need to discuss this with them or not. Can anybody provide that information to me?
Brett, do you think that that's a legal question, or administratively, essentially, we would just let the impacted departments know?
Yeah, as the Funds Commission, you have the legal authority to make this change. Whether or not you decide from a practical standpoint that you should first consult with the different departments that would be impacted, I think Treasurer staff would know better than I would. But again, that's practical. That's policy, not a legal issue.
Right. Well, I think personally, if we're all in agreement that, we're comfortable that, obviously we have the legal right to make this decision, and we're going to be communicating this after the fact to those that are impacted, the recipients of these funds. Given that we're all comfortable with that, I'm in favor of moving forward as the motion conveys.
Got it. And then Commissioner John Peel has a follow-up.
Yeah, I just had a question. Why are we choosing March instead of December for the 3-year average?
I think that's just an effort to get as up to date as possible.
Okay.
I believe this is the closest quarter end to this meeting.
Got it. Okay.
All right, so why don't we go ahead and take the roll call to count the vote again. I'll start with Commissioner Bruce Ives,
Aye in favor.
Commissioner John Peel,
Aye.
City Attorney Mara Elliott,
Aye.
City Treasurer Liz Correa,
Aye.
and myself, Commission Chair David Tam, votes aye. That motion passes unanimously. That concludes the action items on our agenda today. And Jeff, you'll get back to us with the rewrite of the rest of the policy, correct?
Yeah, I'll go back, make those changes and share that. Yep.
Perfect. We will now move on to the next item on the agenda, comments from commissioner staff. Do any of the commissioners, city attorney, or staff have any comments? Hearing none. At each meeting, we invite public comment for up to 3 minutes about issues within the commission's jurisdiction, but not on the agenda. This afternoon, we have 0 speaker slips turned in for non-agenda public comment, so no public comment today. Now we'll move on to scheduling of the next meeting. Let's determine if everyone's availability in mid to late, I'm guessing August, is that correct? Someone correct me if I'm wrong. I think, yeah.
August is correct.
Yeah. The date I have on this is wrong. So let's take a look at August. How about, and Jeremy, are we going to be doing an in-person meeting this time around in August, or?
That's, I mean, it's really going to depend on what the county health orders are and what that all looks like at that time. Yeah.
So I'm going to assume that it is, just to make sure everyone has drive time plugged in, and then Jeremy will let us know if it's going to be virtual. So let's go ahead and flip to the August calendar here. And you're going to have to refresh my memory, but the room we typically meet in, what's a good day of the week for that room in the Civic Center?
Any day but Tuesday, I believe.
Okay.
That's correct.
Got it. Let's move to, how about, here. Wednesday, August 19th, same time, 1:30. How's that look?
This is Jeff. I'm on vacation then. I'm supposedly.
When are you back? When are you back?
That's the last day of my vacation. So I'm supposed to go to Yosemite. We'll see.
Oh, nice.
Yeah.
How about the 20th, or would that be too soon for you, Jeff?
Actually, I think I've got a meeting that day. Hold on.
That's okay. We'll move it. Let's see.
Yeah, that's the 20th. The 20th is the city of San Diego meeting. So both Liz and I will be at that one. So.
How about August 27th, Thursday, 1:30?
That works for me.
Sorry, that doesn't work for Bruce. Sorry.
Bruce, no?
Correct. Bruce, no on that one.
How about Wednesday, September 2nd, 1:30?
Yes for Bruce.
Good for John Peel.
Okay. Liz?
This is Mara. I think that Brett Bartolotta and I might have a conflict that day.
Yeah, there's a proposed DPWG meeting. It's a placeholder right now, and we really never know. So Wednesdays are typically between 1 and 3, are often reserved as just placeholders for those meetings. So if you could go earlier or later, that would work.
What about Thursday the 10th? September 10th, 1:30.
Sure.
Yes for Bruce.
John?
Yes for John Peel.
Liz?
I'm sorry, that day is not going to work for me. I have a conflict that afternoon, unless we did it in the morning.
How is September 10th?
Did September 3rd not work?
September 3rd, I could do that. How's September 3rd for everyone? 1:30.
Works for Bruce.
Good.
Works for me.
All right.
Works for John Peel.
September 3rd at 1:30. Success.
Great.
This is Andrea. I'll confirm the room and send out a meeting invite for the 3rd then if it works for everybody.
Yeah, if it's in person, hopefully.
Yeah, great.
All right, September 3rd at 1:30. That brings us to the end of our meeting. The next Funds Commissioner meeting is scheduled for September 3rd, 1:30 p.m. Thank you, everyone, for attending. Meeting adjourned.
Thank
Thank
you.
you.
Thank you.
Thank you. Thank you.
Thanks.
Thank you.
Andrea Peterson.
Is now exiting.
David Tam.
Is now exiting.